We would never have cash on hand just for the sake of having cash, We would never consider that we should have a cash position of X% C. And to be honest, I believe that the asset allocation strategies that Wall Street strategists put out, about 60% stocks and 30% are complete bullshit. We want all of our money to be invested in respectable companies, but occasionally we can't find them. Or sometimes money comes in unexpectedly, and other times we sell something and have more money than we would like. This means that we have 10 or 15 cents around because we want to use the money, but we'll never use it. If it keeps accumulating, though, I believe we'll find ways to use it eventually, and you'll find us unhappy. May find this hard to believe, but Charlie and I never have an opinion about the market, because it wouldn't be good and it might conflict with our opinions about what we're good at. For example, if we are right about a business and we believe it to be attractive, it would be very stupid of us to do nothing about it because we had an idea about what the market would do or something. Similar, because we simply don't know and we're willing to give up. It simply doesn't make sense to us and doesn't really make a difference. There is nothing magical about something that you do know that is profitable for something that you don't know and won't know as a result. To return to the diversification question, we believe that diversification as a method generally makes very little sense for anyone who knows what they're doing. Diversification is a safeguard against ignorance. We like to invest a lot of money on things that we feel strongly about. That is a totally reasonable strategy for someone who doesn't think they know how to examine firms, provided you know how to do so. If you want to make sure that nothing negative occurs to you in relation to the market you own, everything is okay enterprises and their worth. Owning 50, 40, or 30 stocks is crazy, most likely because there aren't many amazing businesses that are understandable to a single human being. It's also crazy to have some really amazing business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money in number 1. It's standard practice, and if all you have to achieve is average, well, that's a confession in our opinion that you don't really understand the businesses that you hold as part of your personal portfolio. For example, I own one stock, but I am aware that it is a business and it makes me feel quite comfortable. Do I need to buy 28 stocks to have sufficient diversification? That's just bullshit. The typical person won't encounter those 3 amazing businesses, but if you look at how they operate, it's more than you need to succeed in life. Much of what is taught in contemporary corporate finance courses is twaddle volatility, which does not assess risk. The fortunes were built in this country by someone who connected with this and had a fantastic firm, not by a portfolio of 50 companies. Additionally, the issue is that those who have written and taught about risk are not proficient in measuring it. The good thing about beta, a measure of volatility, is that it is mathematical and pleasant, but it is incorrect in terms of measuring risk. It is a measure of volatility, but historical volatility does not determine the risk of investing. Consider farmland here around 1980 and the early 1980s, for example. I purchased one of those farms when the banking and agricultural crises occurred, and it fell from selling for $2,000 per acre to $600 per acre. Place and the beta of farms skyrocketed, and in accordance with standard economic theory, market theory, I was purchasing a much riskier asset at $600 per acre when the same farm was at $2,000 per acre. Now people would consider that absurd because farmland doesn't trade frequently and prices aren't recorded, so they might buy a $600 per acre of the same farm that sold for $2,000 per acre a few years ago, which was riskier but in socks because the prices fluctuate every minute, and because it enables finance instructors to apply the mathematical knowledge they possess. To put it more technically, they have effectively translated historical volatility into various risk metrics, and its nonsense risk arises from the nature of some business types. It can be hazardous to be in some businesses simply because of the basic economics of the type of business in question, and it comes from not understanding what you're doing, and you are aware that it is if you comprehend the economics of the business you are involved in. You are aware of the people you are doing business with. You are aware of the price you pay, and it is reasonable. You don't run any real risks, and I don't believe Charlie and I at Berkshire we have never, I believe, experienced a permanent loss in marketable securities, which was equivalent to 1% or perhaps 0.5% of that value. I made a grave error by purchasing a Dexter shoe, which cost us a much more than 1% of net worth was used when I purchased a whole company. But I was mistaken about the business at the time. It had nothing to do with the volatility of shoe prices, leather prices, or anything else. It was just wrong. However, In terms of marketable securities, I can't think of a situation in which we lost Eon, and we did a lot of things in securities that had a very high beta. We did a lot of things in securities at a low beta. It was just the entire development of volatility as a measure of risk, and we've never found a way for it to be helpful to us. This is true for both corporate finance and investment management courses as taught. We would say that at least 50% of students at the big colleges are twaddle, but these individuals have really high IQs. We've done rather well in part because we realized early on that brilliant people sometimes do really idiotic things. I also wanted to know who these people were so we could avoid them. It's a temperamental trait rather than an academic one. While having a high enough IQ to go from here to downtown Omaha is necessary for this line of work, you don't need to be able to play. Ben Graham would say that you're not right or wrong because 1,000 people agree with you, and you're not right or wrong because 1,000 people disagree with you. You're right because your facts and reasoning are correct. But in three-dimensional chess, bridge playing, or something similar, you need a stable personality and a temperament that doesn't take great pleasure in being with the crowd or against the crowd. You can invest in yourself by, for instance, improving your communication skills. I tell students that they are going to business school and graduate school and are learning all these intricate formulas, but that if they just learn to communicate more effectively both in person and in writing, their value will increase by at least 50%. People say that if you can't communicate, it's like winking at a girl in the dark. Basically, nothing occurs, and you need to be able to express your thoughts and, well, that's that. Comparatively simple, I completed the Dale Carnegie course myself. Of course, some people wish I had taken a shorter course, but it's still very important. And if you invest in yourself, nobody can take it away from you. For example, if I gave you a car and it's the only one you have for the rest of your life, you take care of it like you wouldn't believe it. Fix it right away, read the owner's manual, maintain a garage, and do all these things. You become one body to one mind in this world, and you can't begin caring for it when you're 50. If you haven't done anything by then, you'll have hurried it out. So you should really make sure that you keep in mind that you only have one body and one mind to live with, and that you should make the most of it. The best way to reduce risk is to think in the idea that you have. Say I have 60% stocks and 40% bonds, and then you make a big announcement that we're moving it to 65-35. I mean, that must be complete nonsense. I mean, at 60-40 or 6-53, it just doesn't make any sense. Instead, you should have your default position be always short-term instruments, and whenever you see something wise to do, you should do it. You shouldn't be trying to match up with some goal like that. I found it amusing. I was just reading an article yesterday. I believe it was about the two guys at Google, and all of the issues they're going to face because they're each going to receive a few $1 billion. I mean, I wanted to send a sympathy card. And I nearly went to a Hallmark store because of what the article said. They've got this terrible problem and that terrible problem, and they're going to need lawyers, and they're going to need financial support. They don't need anybody because those guys are smarter than the people who are coming to them, and they don't have a significant issue, and they're very capable of thinking it through themselves. The people who are having the issue are those who wish to sell them their services, and you'll have to persuade them that they have an issue. However, a lot of what you see when you talk about asset allocation is just merchandising. It's a way to make you believe that you don't need these people at all when investing, which I mean the majority of the professionals who tell if you don't pay attention to them and hire them, you're going to have a lot of problems. However, my brother-in-law, who used to work at the stockyards, used to say that people would bring in cattle or something, and I would tell him, you know, how do you get the farmer to employ you to sell the Swift or Armor or Cut instead of the guy right next to you? You know that a cow is a cow and Armor is going to buy it the same way. And he gave me this disgusted look and said, Warren, it's not how you sell them. It's how you tell them, well, that there's a lot of that in Wall Street. Yeah, people have always had this desire to know the future. You know, the king used to hire the magician or the forecaster, and he'd look in sheep guts or something to find an answer as to how to handle the next war. So there's always been a market for people who reported to know the future based on their expertise, and lots of that is still going on. It's just as crazy as when the king was hiring the forecaster, who looked at the shapguts, and people have an economic incentive to sell some nostrum because it can be sold repeatedly. The most intriguing numbers are when you combine the market's underperformance, as reported by the mutual fund industry, which is likely a few points per annum that understates it. Now, if you take all of the mutual fund investors who are continuously switching between funds due to a plethora of brokers vying for commissions, You take a subnormal performance and it drops another 3 or 4 percentage points because of the rearranging of the mutual fund investments. Therefore, the poor guy in the general public is receiving a horrible outcome from reaching out to the professionals, and these men are well known in the area and are in charge of the community chess drive and the scout troop. I think it's terrible. It's far better to earn a living by contributing to a system that benefits the consumers of the goods. But no one stops building gambling casinos or other establishments based on my hypothesis about whether it will be profitable, which is why we frequently do it in this nation. People's desire to gamble and their stock trading, incidentally, comes very close to gambling as defined, but people like to gamble, you know. For example, if the Super Bowl, or even better, a really dull football game is on, and you have nothing better to do, and you're sitting there with someone else, you're probably going to enjoy the game more if you bet a few bucks on it. In any case, the human tendency to gamble is huge now that it was legalized only in Nevada. You had to travel a considerable distance or violate certain laws to engage in serious gambling. But as the states realized what a great source of revenue it was, they gradually made it easier and easier for people to gamble. I mean, when I was here with my kids, I bought a slot machine and put it up on our 3rd floor. I could give my kids any allowance they wanted as long as it was in dimes, so I had it all back by then. Dusk. They weren't traveling to Las Vegas to do it, but trust me, they could find it on the 3rd floor. My payout ratio was also awful, but that's the sort of father I was. I thought it would be a wonderful lesson for him. However, you know that people will always want to gamble, and for that reason I believe that gambling is, in part, a tax on ignorance. That is, if you want to tax the ignorant people who will do things with the odds against them, you simply put it in and guys like me are exempt from paying taxes, and I honestly don't. I think it's kind of morally repugnant when a government preys on the flaws of its people, instead of acting in their best interests. Trust me when I say that when a government sticks a lot of you, I genuinely stated that growth and value are indistinguishable, and that they are either components of the same equation, or that growth is actually a component of the value equation. Accordingly, our stance is that there is no such thing as growth stocks or value stocks, as Wall Street typically depicts them as opposing asset classes, is typically a good thing for value, but only if it means that by investing capital now, you will have more cash available later on at a rate that is significantly higher than the current interest rate. For this reason, we factor in what we anticipate happening in terms of the money that will enter or exit any business we purchase. So if you tell me that you own a company that will grow to the stars, and isn't that amazing? I don't know. The airline industry has been a growth industry ever since Orbital took off. But the growth has been the worst thing that has happened to it. It has been great for the American public, but growth has been a curse in the airline industry because more and more capital has been put into the business at that time. Whether that is wonderful or not depends on the economics of that growth, how much you have to put in today, and how much you will reap from putting that in today later. Insufficient returns. Since it takes comparatively little additional investment to sell more pounds of candy, growth is fantastic right now, and I've talked about this in some of the yearly reports. Growth is a factor, but anyone who advises you to invest in growth or value stocks honestly doesn't know anything about investing. Aside from that, they're great people. The main idea is that they're not that different categories. And I just cringe when I hear people say things like, now is the time to move from growth stocks to value stocks or something like that, because it just doesn't make any sense in general terms. We're trying to put out capital now to get more capital or money later on. If you do that, the business grows, obviously, and you can call that value or growth. Unless you think that a great firm's pricing are extremely insulting, you've probably already recognized it. A great company is, by definition, one that will be great for 30 years. If it's going to be great for 3 years, you know it isn't a great company. You genuinely want to follow through on the idea that if you were going to take a 20-year vacation, you wouldn't feel guilty about leaving the money in with no orders from your broker, no power of attorney or anything else, and you just go, we could try to buy and sell some of the things we own that we believe are good businesses, but they're too hard to find. We found See's Candy in 1972, where we find opportunities to do things here and there, but they're too hard to find. So to sit there and hope that you buy them in the midst of some fear, you know that you'd kind of adopt the mindset of a mortician, waiting for a flu outbreak or something. I mean, I'm not sure that's a great technique. That's a lot to rely on. And you know that if you start with the Dow at X and you think it's too high, do you buy well when it goes to 90% of X? If it goes to 50% of X, you know that you never get the benefit of those extremes anyway, unless you just come into some accidental amount of money at some point. So I believe the most important thing is to find amazing businesses. We've had our share of flu epidemics, but you don't want to live your entire life waiting around bonuses for them. A year ago, people said that cash was king, but that's absurd because cash wasn't producing anything and was only going to lose value over time. On the other hand, you always want to make sure you have enough money. It's like oxygen, but you don't need to have too much of it around you.